Okay, so it's right to go?
Yep.
All right, Mr. Stafford, take it away, sir.
Thanks very much indeed, and thanks for joining the webinar. What I want to have a look at today and in future sessions, a number of issues to do with the legislation changes, and most particularly some of the implications that may not have necessarily been thought through, and a couple of which don't appear to have hit the industry at all, which is making life a little interesting at the moment. The first session we're looking at today is on the pension caps and some of the issues that have come up with respect to those. So just to recap a number of the changes which were finally legislated on the 9th of November last year, we really have three concepts to consider with respect to the pension cap. First of all, we've got the general $1.6 million indexed transfer balance cap. Each person will have one of these, and it basically refers to the general cap of 1.6 million, which will be indexed over time according to their indexing methodology at the rate of CPI in $100,000 increments. That's going to be an interesting one because the concept of your personal cap takes into account the amount of the general cap that you've used in the past. The transfer balance account, which is the third part of the equation, is an interesting one because that represents the individual's usage of the general cap and the personal transfer balance cap. The transfer balance account is actually really quite basic and just represents the value of the superannuation interests that support superannuation income streams. The way the legislation has defined that is quite interesting because it refers to the sum of lump sums that support the value of the income stream. It also refers to certain values with respect to defined benefit income streams, and we also have the issue of what to do with certain flexi pensions and the values that are taken into account there. So what's counted against the cap is fairly straightforward. What's not counted against the cap are, of course, accumulation funds and transition to retirement pensions. Now, the transition to retirement pensions are interesting because they are pensions, but not in the retirement phase, and therefore don't count against the cap. You can basically assume that anything that does count against the cap contains unrestricted, non-preserved benefits only. Now, the transfer balance account operates on a system of credits and debits, and this is where an element of confusion's come in within the industry, because a credit is fairly standard. It's the commencement of an income stream that qualifies. Shuri, if you could just flick to the next slide, please. Sorry, slide 3. Yep, thanks. The credits are fairly straightforward in respect of account-based pensions, but less so when it comes to certain defined benefit pensions and certain term certain pensions, which we'll look at the moment. The other interesting thing is that, of course, the transfer balance cap is a lifetime amount available to an individual, but that cap ceases on death, and we'll come to the issue of what happens with death a little bit later. The transfer balance account, if you think about that, it's a bit like a bank account that has a series of credits and debits. It looks at what you've transferred into the account and what you've debited from the account in the way of commutations. Now, things that don't count towards the cap are the pension payments, the standard pension payments that would come from any form of pension in the retirement phase, or earnings that are added into the fund. Now, it's quite possible that if you've had a pension that's been going for a while and you've got an excess of earnings over pension payments and you fully commute that pension, you could actually end up with a negative transfer balance account. So if we look at what actually counts towards the transfer balance account, you've got the valuation of all superannuation interests supporting superannuation income streams in the retirement phase on 30 June 2017. Commencement value of new income streams on or after 1 July 2017, and that includes death benefit income streams, and we'll look at precisely how they're counted a little bit later. The value is quite interesting because it depends on whether the death benefit income stream is a reversionary income stream or whether the beneficiary elects to take the pension from a death benefit. You've also got notional earnings amounts, and these are amounts that accrue on excess transfer balance amounts and which have to be taken out. That's a debit from the transfer balance account. So as I said on the slide, the changes to the value of an income stream after it's been credited are disregarded. Earnings and pension payments will not be counted into the cap. Cherie, if you could flip forward. Thanks. Now, again, fairly straightforward. The amounts that are debited to a person's transfer balance account are the commutations of capital, partial or full, and you've got certain other things that occur. So family law payment splits are considered to be debits. Fraud. Now, the interesting thing about the fraud, there has to actually be a conviction of the fraudster in order for that debit to actually occur to a person's transfer balance cap. Fraud, you're looking at circumstances where an investment fund, for example, could have been fraudulently managed, and we've referred to a couple of those a couple of years ago. That would then be a debit to the transfer balance cap. Void transactions under the Bankruptcy Act, we refer there to contributions which have been put to superannuation for the purpose of avoiding creditors. This is not new, but it's interesting that they take it up as a potential debit to a person's transfer balance account. To get a debit recorded, the monies must either leave the superannuation environment entirely or they commute to the accumulation phase. Now, the interesting thing there is up until 30 June 2017, 30 June coming, we can still take out lump sums under certain circumstances that are counted towards the minimum annual pension payment requirements. This can be quite useful for someone who's aged between preservation age and has yet to turn 60, because it means you can take out a lump sum and the election to have it treated as a lump sum is made on a prospective basis, in other words, before the withdrawal is made, and it gets counted against the minimum annual pension payment requirements. Now, for a number of reasons, this can be quite lucrative, particularly because if it's done for a person between preservation age and under the age of 60, it gets counted against the low rate cap and therefore not taxable. So depending upon the client's marginal tax rate, that could be an extremely beneficial way of ensuring that the minimum annual pension payment requirements are met and not pay any tax on that particular lump sum withdrawal. Cherie, if you could flip forward. Now, where it starts to get really interesting is where we look at what happens if the transfer balance cap becomes excessive. So in other words, where the personal transfer balance cap is exceeded. Now, the personal transfer balance cap will be adjusted. We'll talk about indexation in a moment. So when the first level of indexation occurs, and I would assume that that's going to be in roughly 5 or 6 years, we're going to see circumstances where the general transfer balance cap is not necessarily the same as the personal transfer balance cap, depending upon how much of the personal transfer balance cap has been used by the individual. Now, let's assume that we have got an excess transfer balance. That excess balance will accrue notional earnings. And this is where it starts to get very interesting because it's broadly based on the general interest charge and is compounded daily. That's actually a quite important point. And the amount at the moment that it's increased is 8.76%. Now, the notional earnings will then be also credited to the individual's transfer balance cap. Anyone who is in excess will be required to commute their retirement income stream to remove the excess, including the notional earnings. And the individual will be subject to excess transfer balance tax, which is payable on the notional earnings. Now, the interesting point about the notional earnings is that the individual can actually take action prior to any communication from the ATO, and therefore can reduce the time frame over which the notional earnings calculations would be applied. So given the fact that this is compounded on a daily basis, the earlier an excess can be identified and self-rectified, the better for everybody. Now, as I say, the individual, not the super fund, is responsible for the excess transfer balance tax. In the year 2017/18, the rate is 15%. Thereafter, it is also 15% for the first breach, rising to 30% for any subsequent breaches. This is part of the integrity measures that have been introduced by the government. It's another way of grabbing a bit of extra tax. Now, as I say, the notional earnings compound daily, but only until such time as the ATO issues an excess transfer determination. The tax will be payable within 21 days of receiving the notice of assessment. Cherie, if you could flip forward. However, when the Commissioner issues the determination will give details of the default fund and default pension to which the Commissioner will issue a commutation authority. And that's an instruction to the fund to partially commute the pension so that the individual is brought down at or below their cap. However, the individual, if they have a number of pensions and believes it is strategically better to commute partially another pension, they have 60 days to advise the Commissioner if they wish to nominate a different pension to be commuted. The Commissioner will then issue another determination, a commutation authority, and the fund must comply with that authority within 60 days, notify both the Commissioner and the individual that it has done so. Now, this is where the integrity measures start to get a bit interesting, because in the unlikely case that a fund fails to comply with the commutation authority, the full amount of the pension, and I emphasise the full amount and not the excess, will be deemed to have ceased being a pension for tax purposes at the start of the income year in which the fund failed to comply. Now, bear in mind that that may not be the same income year where the excess actually occurred, but the big kicker in all of this, if the fund fails to comply with that commutation authority, the fund fails to be a pension for the tax purposes in all later years. You are permanently depriving yourself of the ECPI exemption. So you would imagine that in cases of retail funds, industry funds and whatever, they'll be working very, very hard to ensure that doesn't happen. But I can foresee circumstances where self-managed superannuation funds may inadvertently be in a position where a commutation authority is difficult to obtain because it could go through MyGov and someone doesn't look at their MyGov account to pick up any letters. The ramifications of this are really quite significant. Now, we also believe that if the pension remains in place, you lose the ECPI exemption, but it would appear that you're then able to commute the pension in full and commence a new pension, subject to precisely where you sit with your own personal balance transfer cap. So the point with respect to the commutation authorities, don't ignore them, expect them to arrive and deal with them within the time frame. The loss of the ECPI exemption is particularly significant, and we don't want that to happen for any client, principally because we know who's going to get the finger pointed at us. Cherie, if you can flip forward. Now, the ATO and Treasury recognised that there are going to be certain breaches that occur for the simple reason that not every fund is going to know precisely where it sits with respect to pension balances on 30 June. So there's transitional relief being offered for the first 6 months of the 2018 income year and will apply where there's only been a modest increase that's created the excess, and that the excess is self-rectified within 6 months. So in other words, it's incumbent again upon the individual to look at their super fund, for the advisor to do the same, and to take action to rectify the excess within 6 months. If the ATO has to issue a determination, then all bets are off. You do start to incur tax and notional earnings. If the transitional relief is applied, there will be no notional earnings and no notional earnings tax. However, and here's another little kicker, the eligibility for the transitional relief is lost if the transfer balance account receives any other credits during that first 6-month period. So in other words, if the client inadvertently triggers a pension during that 6-month period that would be counted towards the cap, all bets are off. Bear in mind too that a new pension is a retirement phase pension, not a transition to retirement pension. It would be particularly important, I think, to actually make sure that we're looking at the balances as of 30 June as soon as possible to determine whether self-rectification is necessary and what we need to do in order to be able to self-rectify. Cherie, if you could flip forward, please. Okay, now this is when it starts to get very interesting, because the measurement of an account-based pension against the pension transfer balance cap is very straightforward. We're looking at the asset value being counted towards that transfer cap. Defined benefit income streams, however, are another issue, and part of the problem comes with the way that the legislation has put together the various rules surrounding defined benefits. Included with the defined benefit pension category, you've got market-linked income streams, or term allocated pensions, use the terms interchangeably, and you've got flexi pensions. Now the issue with the flexi pension is that it's actually not considered to be a capped defined benefit income stream. The reason being that a flexi pension can be commuted. Flexi pensions were often put in place in RBL days for compression purposes. You could add a large undeducted contribution, utilise the particular formula and actually drop the pension capital value below the lump sum RBL, and you could get some significant benefits from doing so. The problem with flexi pensions is that the commutation value is almost certainly going to be less than the asset value that supports the pension. So whilst it can be commuted, you've got some significant issues dealing with the technical matter of commutation. So despite the fact that these are true defined benefit pensions, they are not included under the current rules. So if we look at what is a defined benefit pension, you've got what you'd expect. You've got lifetime pensions, which can be commenced at any time. They don't have to be in position before 1 July 2017. Lifetime annuities. These have largely disappeared from the marketplace, but are still able to be purchased. You've also then got market-linked pensions and annuities, and life expectancy pensions and annuities, both of which need to be in place before 1 July 2017. Now, the concept of having a defined pension, such as a market-linked pension or a life expectancy pension, is incongruent with lifetime pensions and lifetime annuities, but they have been lumped together for the purposes of this part of the legislation by Treasury and the ATO. It's created problems because the valuation of market-linked pensions and annuities are dealt with in a particular way to create some significant problems, which I'll come to in a moment, with respect to valuations against the particular caps that we're talking about. The date of commencement of these types of income streams is important, with the exception of lifetime pensions, which can be commenced at any time and counted against the cap defined benefit income stream cap. The others have to be in place on 30 June 2017. If, for example, that we commute a TAP post 1 July 2017, they're not counted as cap defined benefit income streams, And to be blunt, no one's quite sure at the moment precisely how these are going to be handled against the transfer balance cap. If a pension commences from any one of the named life expectancy, market-linked lifetime annuities or pensions, it's the date of the commencement of the pension, not the date of reversion, which is important to ensure how the rules are applied. Sheree, if you could flip forward, thanks. Now, this is again where it gets interesting, because the draft Treasury Laws Amendment regulations was released for comment late last year, and it appears to offer the capacity to commute a non-commutable pension, so a contradiction in terms, if the governing rules for the fund permit. The draft regulations have yet to be promulgated. The period of review has only just finished for the regulation, so we still don't know what's going to happen. I've looked at a number of trust deeds over the past month or so to determine whether there is capacity within standard SMSF trust deeds to be able to provide for the commutation of a non-commutable pension. Not one of the trust deeds that I've had a look at appears to allow that. So it would be unlikely that a number of funds are going to be able to commute a non-commutable pension unless the deed is changed and unless the changes to the deed are compatible with the regulations. When we get to looking at the valuation of a capped defined benefit income stream, we have a look at what they refer to as the special value. Now, it is a separate balance, and it's referred to as a capped defined benefit balance. And if you think about that, it's rather like having a sub-account of an individual's transfer balance account. The two accounts are looked at together, but separately. So the sub-account only deals with the credits and debits which pertain solely to the capped defined benefit income streams. Sheree, if we could jump forward. Now, where you've got lifetime pensions and lifetime annuities, the very simple calculation methodology applies a valuation of factor of 16 to the annual entitlement. The annual entitlement is measured by looking at the first payment that's made in the 2017-18 income year and extrapolated to an annual figure. So the example here on the slide, if we have a fortnightly payment of $2,500, the annual entitlement is the $2,500 divided by 14 days, multiplied by 365, which gives us an annual entitlement of $65,178. The special value in respect of a lifetime pension or lifetime annuity is therefore $1,042,848. Now, the interesting thing with respect to these particular type of pensions or annuities is that it makes no allowance for age or any other factor. It is a single factor of 16 that's applied. Now, this to me would tend to imply, if we look at a pensioner age 65 who has a lifetime pension and a pensioner of 80 who has a lifetime pension, both pensioners are going to be treated in exactly the same way. Interestingly, if we look at it from an actuarial percentage, a more appropriate figure for the 80-year-old might be 8 or 9 times. So again, there are going to be some people who are disadvantaged. Interestingly, they're going to be former public servants in the main. I'm not quite sure why there hasn't been more of a fuss on that particular issue. Now, the next problem occurs when we start to have a look at market-linked income streams. Sheree, if you could flip forward, thanks. Now, the special value of life expectancy pensions and market-linked income streams is slightly different, because we look at the same annual entitlement calculation, but multiplied by the number of years remaining in the term, which is rounded up. So if we look at a situation where we've got a market-linked income stream with 20 years remaining, we look at the same calculation values as before. we end up with a counting of 1.3 million or so. Now, this starts to get very interesting because a lifetime methodology, I can cope with that. I don't think it's particularly fair. But in all cases with respect to a market-linked income stream, if we're using the standard payment factors, we are in a position now where we're seeing a premium attached to the countable value for special value purposes compared to the underlying asset value of the market-linked income stream. Now, for the moment, let's ignore the final comment on that page. We'll see it a little later in the next slide. Sheree, if you could flip forward, thanks. This is probably a little difficult to see on the presentation there, but what I did there was to look at a market-linked income stream with terms remaining from 35 down to 1 year, and looked at the payment factors, and I've just assumed an asset balance of $1 million. With the standard payment factors, we're looking at an excess, a premium attached to the asset value of up to 75% of the asset value. So if we look at the very first one, term remaining 35 years, payment factor is 20. On $1 million asset base, the standard payment would be $50,000. Multiplied by the term remaining, you've got a cap valuation for special value purposes of 1.75 million. That's a huge excess to take into account. So the circumstances could be that you've got a client who's got an asset value in a market-linked income stream of $1 million. You've got an account-based pension of $599,000. You could look at that and say, wacko, we're below the pension cap. We don't have to take any action whatsoever. However, you've actually got a countable value against the individual's personal transfer balance cap of roughly 2.35 million, and you will therefore have to take action because there is that excess value of 750,000. For every year, bar the last year, where numerically the term remaining and the payment factor are identical, are you going to see an excess over the asset value? Now, of course, with a market-linked income stream, you can take, depending upon the commencement date of the income stream, you can take up to 10% less than the standard payment amount or up to 10% more. So the next two sets of figures look at what happens. Now, if we look at the excess where you're taking a 10% lower amount, then we can see that only in the last 5, 4, 3, 2 years is there going to be a discount to the asset value. So this would imply to me that the first payment that should be taken in the income year, commencing 1 July, should be based on a 10% less figure than the standard payment valuation, on the basis that, of course, the annual entitlement is extrapolated from that first payment, notwithstanding that it may be your intention and the client's intention to take 10% more than the standard payment. There doesn't appear to be anything in the legislation that would preclude that counting happening in that way. This therefore gives rise to several strategic issues with respect to treatment of market-linked income streams prior to the commencement of the new regime on 1 July. Sheree, if you could move forward, if you could. So the question that I would ask is, should the market-linked income stream be commuted and a new market-linked income stream commenced with different parameters in respect of term remaining? This can be done because, don't forget, one of the few circumstances in which a market-linked income stream can be commuted, apart from death, is where you're commuting it to commence a new non-commutable income stream. I think in virtually all cases, I can't see a circumstance where you would not want to take the first payment on the basis of the minimum possible that you can do. We may need to look at excess issues and dealing with an account-based pension that may need to be commuted in part or full if an individual has an excess that requires treatment. Now, if it's solely the market-linked income stream, you may need to look at a circumstance where you may wish to commute. We've had a look at a number of market-linked income streams here that are roughly $5 million in value plus. And my particular view with those market-linked income streams is I wouldn't want to touch them unless there was a circumstance where the treatment of the income from the market-linked income stream was going to create a problem. There are some limitations into how far we can stretch the term remaining, but it's worth looking at for a number of reasons. If we have the option to commute, then it's not a mandatory commutation. It's an option to commute and an election to commute. And in cases where we're looking at the moment, I'd rather not commute a $5 million market-linked income stream for the simple reason that I have exempt current pension income resulting from an asset base of $5 million, which is taxed at 0%. If I commute, I'm going to have money sitting in the accumulation phase or taken outside the superannuation environment, and that could be taxed at either 15% in the accumulation phase or whatever would apply externally to superannuation for that particular client. We still don't know whether the regulations are going to allow the commutation. My view is that subject to the level of excess, you're not going to worry about the need to commute because of the value of the ECPI exemption being in place. Cherie, if you could flip forward, thanks. If we go back and start to look at what's going to happen in 5 or 6 years when indexation first hits, the general transfer balance cap is going to be indexed in $100,000 increments, so will rise to $1.7 million. The interesting thing with the personal transfer balance cap is that we start to look at, well, how much of that indexation is the client, the individual, going to be eligible to apply? And so what you need to do is to identify the highest transfer balance amount during that period of time between 1 July 2017 and the implementation of the first level of indexation. Compare that to the personal transfer balance account, the personal transfer balance cap, and then express the amount as a percentage. So the simple calculation is you've got your personal transfer balance cap less the transfer balance divided by the personal transfer balance cap times $100,000. Easier to look at an example. So if we flip forward, we've got, and for those of you at the conference, you'll remember looking at this one. There's no difference between the information we had at the conference and what came out in the legislation. If we look at this particular situation, Hines commenced an account-based pension in 2017-18 and used 50% of his $1.6 million personal transfer balance cap. When the transfer balance cap is indexed to 1.7 million, his personal transfer balance cap is then increased to 1.65 million because he's already used 50% of his personal transfer balance cap. Therefore, he's got an unused percentage of 50%. You multiply the unused percentage by the $100,000 increment, and you can therefore get to the total figure of 1.65 million. So you can see we're starting to get problems when we have to look at the personal transfer balance cap, the personal transfer balance account, and the general cap at the level of at the timing of the first indexation point. Hines, therefore, in this particular scenario, could start another account-based pension, for example, of up to $850,000 to fully utilise his personal transfer balance cap that was indexed. Cherie, if we can go forward. Now, of course, we then get an issue where indexation is going to occur then at hopefully a slightly earlier point in time, maybe 4 years, following the level of the first indexation increase. And if we look at a circumstance here, we can start to see where, depending upon precisely what account-based pensions or other income streams have been counted against the personal cap, are going to affect the level of indexation that's able to be applied. The biggest concern that I have with a number of these particular scenarios is that we're going to be absolutely reliant on the recording of all this information, and we're going to be reliant on the ATO being able to give us that level of recording and that accuracy of recording. And for those advisors of sufficient chronological benefit who can remember the RBL days, one of the biggest problems we had with RBL reports coming out of the ATO was the inaccuracies in those reports. I'd say from my experience, and being very polite, that it was a minimum of 20% of RBL reports that had material inaccuracies. The rest had some inaccuracies that weren't necessarily worth arguing about, but significantly material inaccuracies caused by the reporting methodologies. I've not got too much confidence that there is going to be too much change in that going forward. Now, if we go forward again, we can have a look at some terrible examples of what might happen with respect to having to calculate a person's entitlement under successive indexations of the transfer cap. Cherie, if we could flip to slide 18, if you wouldn't mind. Now, this is where we're having a look at what happens if the personal transfer balance cap is exceeded, and we start to have a look at what's going to happen with respect to excess transfer balances and the determinations received from the ATO, and looking at how much actually has to be released by the fund through that default commutation authority. So the interesting thing there is this was obviously gotten onto quite early because there's only 14 days of notional earnings. But you can see how it starts to add up on the excess, and the amount of the excess plus the notional earnings comes out of the super fund in the required time frame. Henk, in this particular scenario, is required to pay the 15% tax on the notional earnings and has to pay that within 21 days. These are relatively tight timeframes, and if we look at the capacity for the ATO to get the relevant information out in time for someone to take action, 21 days might sound a lot, but it is not necessarily significant. Cherie, if you could flip forward, thanks. Now, one of the more interesting issues, pardon me, that we've got is with respect to how death benefit pensions are going to be counted against the beneficiary's cap, because of course the individual loses their transfer balance cap at death. There is a big difference between the treatment of reversionary pensions and the treatment of non-reversionary death benefit pensions. A reversionary pension, of course, is one that automatically reverts to the surviving beneficiary and commences immediately on death of the original pensioner. A non-reversionary death benefit pension is an income stream which is elected to commence by the beneficiary from the death benefits from the deceased. Now, the interesting thing with reversionary pensions is that they are only counted against the beneficiary's cap 12 months after the date of death, not the date of death itself. So that 12-month period is actually quite important. The non-reversionary death benefit pension is treated quite differently, and that particular type of pension generally must be commenced within 6 months from the date of death in order to receive various benefits. But the counting is when the election is made, and the value that's counted is the value at the time that the election is made. So you can imagine that there are going to be circumstances where The reversionary pension could have an increase in earnings over a 12-month period. It could be substantially higher than the value at the date of death. That's not captured because it's the value at the date of death that's important for the reversionary pension. Pardon me. The standard death benefit pension, the non-reversionary amount, could equally be the same. You could have an increase in earnings over the 6 months. That increase in earnings is taken into account. Now, if we start to look at it, one of the interesting issues at the moment is, well, what happens if you've got a death benefit reversionary pension, which also contains insurance benefits? From what we can see in the legislation at the moment, and I've discussed this with a number of tech people in the industry, it would appear that the insurance benefits may not be captured at all against the value counted against the beneficiary's cap, because it's the value at the date of death that's important. Now, I can't foresee a particular situation where the insurance company is going to pay out on the date of death. It's always going to be weeks, if not months later, for that to be received. So it would appear to be a strategic option to be able to hold an insurance policy in a particular account, fully paid for by that account at the request of the original pensioner, and not get captured. This could end up being a very good strategy if the reversionary pensioner was able to keep that pension in place. You'd have a hopefully significantly larger amount of ECPI exemption applied to those assets. Now, we'll be looking at a lot more detail with respect to death benefit pensions and reversionary pensions in later webinars, but I wanted to throw that one up because there is a significant difference in the treatment of those standard death benefit pensions. One of the things that we also have to look at too is, because of the counting against the beneficiary's cap, we're then going to have to look at, well, what happens with the death benefit pension if the combination of the death benefit pension, reversionary or non-reversionary, exceeds the beneficiary's cap, because the beneficiary may have in place an account-based pension as well, let's say to 1.6 million, something needs to be done. Therefore, if you have a look at some of the strategic options available under that death benefit scenario, you've got the capacity for the beneficiary to say, okay, well, I actually want to keep the reversionary pension in place because I've had the payout come. The death benefit reversionary pension will keep me within my cap if I commute my existing account-based pension to the accumulation phase. That way, you've kept a large amount of money within the superannuation environment, which could be a better tax result for the client than having to forcibly commute the death benefit pension. The important thing to look at with respect to death benefit pensions is that you can only do one of two things with a death benefit pension, whether it's reversionary or non-reversionary. It either remains a death benefit pension or it is commuted from the superannuation environment entirely. We can't get to a point where we are able to currently, where a death benefit pension could be commuted to the accumulation phase and held after a relevant time frame, generally again within 6 months, or sorry, outside 6 months, or after 3 months after the date of probate. There were considerable benefits in being able to do that under certain circumstances. That particular strategic option is going under the new legislation. We cannot treat the death benefit pensions in any other way other than keep them as death benefit pensions and or fully commute or partially commute out of the superannuation environment. The interesting thing also with respect to death benefit pensions is that the death benefit pension can be rolled over. In other words, it is always going to retain its categorisation as a death benefit pension until the death of the beneficiary. It's an interesting scenario. Quite how this is all going to be done, I'm not too sure, but we're going to see considerable differences in reporting. Now, in respect of the reporting for a lot of these issues, we can start to see that there's going to be a very strong reliance on the information provided to the ATO. Now, under most circumstances, with retail funds and industry funds who have reporting obligations, that's not going to be too much of a difficulty. The difficulty comes with respect to the reporting in respect of self-managed superannuation funds. And recent noises from the ATO would tend to indicate that their concept of, open quote, real-time reporting, close quote, is going to provide some significant imposts with respect to administration of self-managed funds and the capacity to be able to report on timeframes which self-managed funds haven't been used to in the past. Quite where we'll end up with that. Last week there was a presentation by the Deputy Commissioner for Taxation Superannuation to the SMSF Association annual conference, which indicated that they're trying to push for real-time reporting to come into place sooner rather than later, and there's some noises that we may need to expect some changes to reporting coming in the 2017-18 income year. Now, for the moment, that's all I've got with respect to looking at certain issues to do with the pension cap. Personally, my view is that I think it's going to be complex to administer. I've described the changes that are occurring as one of the biggest dog breakfasts I've seen with respect to legislation in the past 20 years. We're going through a system of complexity with respect to approaching integration into the system, and we're going to lead to an increased level of complexity going forward, particularly when indexation starts to be applied to the cap. So I'll throw it open now, if I could, to any queries or any questions.
All right, well, thanks for that, Neil. Cherie's just taking everyone off mute at the moment. We'll seem to have lost the screen there. Cherie will get it back, I'm sure. Okay, so does anyone have any questions? I mean, obviously you can contact Neil offline and discuss anything that you want to discuss. But if there's anything that you want to ask now while everyone else is on, please do. Everyone's head must be still spinning, Neil.
Look, one thing I should point out, and the question's arisen a couple of times recently, there is nothing in the legislation that will tell you whether you have to commute one or more pensions. Sorry, let me explain that again. If you've got, for example, two pensions that cause an excess over the pension transfer balance cap, the ATO is going to send you the determination to tell you to commute one of those pensions. There is not an obligation to commute both of those pensions. All they're looking at is getting a monetary amount to bring that individual down below their personal transfer balance cap. So you could do one of a number of things. You could actually commute part of both of those pensions that gave rise to the excess in total. You could look at partially commuting one of the pensions. You may have to totally commute one of those pensions. And you can elect which of the pensions or both of those pensions the commutation has to occur from. So look at it as a monetary issue, not necessarily an account-based issue.
Well, I guess from an advisor's perspective, Neil, I guess it's an opportunity for the advisors to work closely with the clients that are going to be impacted and to basically, drive that process. Because the one thing that sort of came out of it is if the client, with the help of the advisor, can get on top of these issues and sort it out, that's going to be a much better result, yeah?
Absolutely right. The second webinar that we're going to do is on the CGT transitional relief. So where it's obvious that a client is going to be over the pension transfer balance cap, on 30 June 2017, then we've got the opportunity to look at the CGT relief, whether we actually want to undertake the CGT relief and whether we want to defer the resulting capital gains tax liability further forward. The interesting thing there is that there's a very significant amount of work that's going to be involved in looking at the CGT issues alone. So the sooner an advisor can get onto this, and interestingly, there's been some very uninformed comments coming from clients who've been reading things in the media which have given very wrong perspectives as to the changes. The sooner an advisor can get onto this and in front of a client, I would have thought the better for the relationship with the client.
Yeah.
The other thing that should be added to this too is that there are contribution capacities over the next few months that are going to disappear on 30 June 2017 and which are worth looking at for the sake of trying to get rid of as much taxable component where superannuation is able to be accessed and contributions able to be made.
Yeah, absolutely. Absolutely. All right, very good. Well, what we'll do is give everyone the opportunity to digest what was just went through. Obviously, there's some pretty big changes, and as you mentioned, Neil, there's a lot of stuff in here that's yet to sort of been clarified on how it's going to unfold. So in saying that, the webinar is recorded, so you'll be able to access that. And then, of course, we've got another one coming up very shortly, which will build on what we've done today. But I think as a start, we need to start thinking about clients that are going to be impacted by this, so we can sort of have 30 June in mind as a date. That's when it's all going to get real. All right. Well, thank you very much, Neil. Thank you, everyone, and we'll talk soon.
Thanks very much indeed, everybody.
Thanks, Neil.
Thank you.